Hi, Lee Phillips here again. Yeah, I'm still a lawyer. Don't hold that against me, okay? I want to talk to you for 2 seconds about what makes a qualified subchapter S trust. They call it a QSST or qualified subchapter S trust. And basically it's a trust that is able to hold subchapter S stock. And your little business is probably set up either as an LLC or as a corporation. And if you're selling goods and services, you are probably taxed under subchapter S of the IRS code. In order to avoid probate when you die of the business, you're going to want that subchapter S stock or the membership interests in the LLC that's taxed under subchapter S. You're going to want those in a trust. That way, when you die, there's no probate on the ownership of the business, and the kids or whoever can just carry on. So it's important that you put it in the trust, but it's also really important that the trust qualifies as a qualified subchapter S trust. There are basically two big elements that you've got to have. One is you have to have a single beneficiary of that trust. The IRS wants to know who's going to pay the tax because the subchapter S stockholder gets the K1 and they pay the tax. So the IRS wants to know who's paying the tax. And if I've got a trust with 6 trillion beneficiaries or even 10, the IRS is scratching their head because they don't know who's going to pay the tax. So your qualified subchapter S trust has to have only one beneficiary. Now, mom and dad are usually the beneficiaries of their living revocable trust while they're alive. Mom and dad file a 1040 form jointly. As far as the IRS is concerned, that's one beneficiary for the tax aspects. So we've met that. The other thing is the trust has to say that mom and dad get all of the income from this trust. So we now know where it goes and who it goes to. There are a number of other aspects to it. We can't have a foreign individual be the beneficiary. It has to be the U.S. citizen, like under subchapter S generally. The trustee can't be a foreigner. There are a number of rules that you have to go through in order to be sure that this is a qualified subchapter S trust. But the big ones are one beneficiary, and the trust says that all of the income is paid out to that beneficiary. And it can say annually, quarterly, or whatever, but it has to be at least annually. So we know who's going to get the K1. It's that guy, and they're going to pay the tax. The other thing you have to do is within 2.5 months of your putting the subchapter S stock or the membership interest in the LLC into the trust, you have to notify the IRS that you have moved this stock into a subchapter S trust, a qualified subchapter S trust. If you don't do that, if this isn't done right, 5 years from now, the IRS audits you. They determine that your trust really isn't a qualified subchapter S trust. Then what they do is they go back and say, time out, you had an owner of subchapter S stock in your company, subchapter S memberships in your LLC that didn't qualify. This isn't a subchapter S corporation or an LLC taxed under subchapter S. This is a corporation. We'll give you that. Or it's taxed under the corporate rules. We'll give you that. If it's not a subchapter S, what's it got to be? Oh, it's a subchapter. No, it's a chapter C entity, like a C corporation. The only way you get money out of a C corporation is by either paying a wage subject to W-2, 16% basically tax, or a dividend, which is double taxed. Because when you pay the dividend out, it is not a deduction to the company. And when the individual, so that the company, the C entity, has paid tax on all of its income. It then gives part of its money to the shareholder. It does not get a deduction. So it's paying an after-tax dollar to the shareholder. Then the shareholder gets that in their little greedy pinky, and they have to pay income tax on it too. Double taxation. So the IRS comes back and says, no. This didn't qualify as an owner of a Subchapter S entity. Therefore, by default, it's a Chapter C entity, C corporation, or an LLC taxed under C. And remember all those distributions you've been making out for the last 5 years? Those need to be taxed at the company level, and then they need to be taxed at your level, and they will go back and assess that tax. And that means you can be paying like 60% of the money that you've taken out of the company in tax. This is a big tax bill, guys. So when you're moving Subchapter S stock, you've got to be very careful. In another YouTube video that I have about Subchapter S stock, I talk about when mom and dad die, you've got to take the stock out of the trust and actually distribute it out to the beneficiaries within a 2-year period. Otherwise, we're right back to where we were. This is not a Subchapter S entity. This is a Chapter C entity, and we're going to re-tax you. So watch what you're doing on it. It's kind of snaky. The trust I have for you in the Accumulation Preservation Wealth Set is a qualified Subchapter S stock. Now don't forget to subscribe for me. In fact, tell your friends about it. And we will catch you on the next round. How does that sound?